Hello, everyone. Hope everyone is having a great weekend. This past week was a little bit of a fun one overall in the market, basically, thanks to the Thursday and Friday action. We're going to go ahead and analyze the NASDAQ. NASDAQ kind of looked like it was consolidating overall. We were unsure if it was bullish or bearish. But on Thursday, the NASDAQ broke significantly hard from this kind of pennant pattern. If you connect the lows here and the highs right here, it broke right below that on above average volume, and that along with the heavier volume intraday reversal the day before to make it appear like churning, appeared that things were going to get pretty ugly pretty fast, and the minimum 50-day moving average, 200-day moving average test coming right up. Then let's go look at the New York Stock Exchange. You can see the same thing, significant break, still above the 50-day moving average, but the break there on the shortest term trend is obvious. Dow Jones Industrial Average still looks fine, so nothing wrong there. But more significantly and more importantly, the Russell 2000 took out the 50 and 200-day moving average. Now, if we would have seen, now one thing, I got a couple questions. How come I only put 2.5% in my SRTY ad? Because even though it's a brand new break of the 50 and 200-day moving average, we are straight down off the highs on the Russell 2000, and it's a very oversold move. Let's say that we would have moved sideways for weeks and weeks to possibly even a full month, just like in a kind of a short, tight range, and then broke below this 50 and 200-day moving average. On Friday morning, you would have seen me put 5-10% in a leveraged position like that. That's the exact same reason why we went long SOX S based on the SMH breakdown on heavy volume. We had to take that position. So on Friday, then, what we got was a big market rally. So the NASDAQ retook back all of its losses from the day before, but once again, the problem, which is why nobody should get bullish here, is that volume was lower than the session before. So we remain very neutral on this index overall, and right now it's still consolidating above these recent lows and below these recent highs. So we continue to wait for a resolution of that pattern before making our next buy or sell decision in our market timing model. So it's still neutral. Then NYSE pocket pivot point signal, S&P 500 pocket pivot point buy signal, and the Dow Jones Industrial Average pocket pivot point buy signal right near the 50-day moving average. So these indexes look great. They're not back into a buy condition just yet because the Dow Jones still isn't above its previous high. The S&P 500 needs to break out to a new high, and the same thing with the NYSE needs to get above at least these highs on Wednesday. Then those models will switch back to buy signal. The Russell 2000 though switched to a sell signal with the move on Thursday. That's just why we added to our hedge. But a very bullish condition happened. We retook the 200-day moving average on a very nice move, and we engulfed the pattern, which means we opened below the close and we closed above the open of the previous session. So it's a very bullish engulfing pattern on a price level, and we retook the 200. Now, if we retake the 50-day moving average, which I thought by the end of the day we were, so I'm mistaken because I believe in somewhere in my analysis I took that we retook the 50 200-day moving average. That makes me look stupid, but that's what you get for jumping the gun and posting stuff before you do your appropriate research. So the Russell 2000 looks very bullish. If it retakes the 50-day moving average, even more bullish, but still all it is neutral. We're in a widening range now. If you connect like these most recent highs and then these most recent lows, you can see that it's getting wider. The band is getting wider. And so that is that with those indexes. And then the good news is that we do have some new long positions. Before that, I want to go over with the hedging that we got to get off. So the SRTY ad that we had on Thursday needs to completely come off in the morning because the pattern completely broke itself, broke below the low of 39.33. BIS, even though we still have a gain, because of our second long position coming with a gnarly gap up in our inverse ETF, thanks to the biotechs gapping down. Friday session now puts us with a 1478 close, which is below the 1495 low a day of that day. So I want to take off 25% of my total BIS position. And SOXS, it still looks fine overall, but the open was at 1920. It's closing at 1916. So we're going to take off 75%. I want to go ahead and use the 1847 level now to get rid of the rest because it still looks like it's a solid setup. and we'll see if we resolve ourselves lower on these indexes and the semiconductor sector. And if that's the case, then I definitely want to keep a little bit of this position going, and then that way if it re-breaks out and I have to add back, I won't feel totally foolish for selling all of it. Our new long positions, there were a whole bunch of them first off, but a lot of these have earnings coming up. So just to let you know, we got signals in TRN, LNG, IVC. All of these are higher quality stocks. URS, BRCM, as you can see, UNP, SHLM. These are all high price, high quality stocks. However, they all have earnings coming up. SHLM does not. To me, this base is too short with the 50-day moving average too far away. If this base was even just 1 week longer, and then today's breakout move happens with all that pretty green bop on the bottom of my screen, I'm going to get long. But with the base so short here, if SHLM runs, it's going to have to run without me. I just can't buy it with it this far away from the 5200 and that short of a base. What I will be going long, though, are three stocks. Kate Spade and Company is breaking out of basically a cup with handle pattern and a volatility contraction pattern, ascending base-like action. The long-term chart, as you can see, looks very strong, so it appears after this coiling for the past month, Kate is now ready to move. The biggest issue is Kate has earnings coming up at the very end of the month, and volume is below average. So this is only a 2.5% position. And with the current condition, even if earnings weren't coming up, it's still only 2.5%. Volume's below average on this breakout. Very little confirmation. However, it might be an early move. So we'll get it started. And if it's wrong, if it closes below 38.25 at any point before earnings, we're completely out. And then the next long is GB. GB is the fundamental powerhouse out of all the new long positions. It's producing another pocket pivot point signal. It's had, 10 of them since May and had 0 pocket pivot point sell signals. And this ascending base breakout pattern, as you can see, it's just drifting higher now, trying to go to 100. That's what I like to think. And so GB is a good play. Like I said, strong fundamentals, but once again, it has earnings coming up. So if it doesn't move immediately, it's got to go. And 49.18 is the final cut loss. There is no other level. And then the one new long position, that if this was a normal market, let's say that earnings weren't coming up on this stock either, it's a 5% position. Let's say this is a non-QE market where I can trust long and short signals like I could before 2008. MCK, this is easily a 10% position. You can see how coiled the price pattern is in June and July, and it's now coiling and tightening into this very extremely tight trading range, and is now producing a pocket pivot point buy signal off the 10-day moving average and right near the 50-day moving average, as it's just a few cents away from a breakout to an all-time high. Like I said, sadly earnings are still ahead, but a close below 188.92, 188.20 will be completely out. We have a little over a week to know if we're right or wrong, but if MCK can fall through immediately on the breakout, we know that probably earnings are going to be good no matter what. So there's a lot of action out there. Like I said, one of the biggest selling points to me that this rally might be okay again is the way that Skyworks reacted after its ugly session on Thursday, then to have a viable gap up and follow through. All of that suggests that stocks could easily resolve themselves higher, but it's just not worth it until earnings are over and this trading range that we are in is resolved. Thank you.